Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if a company's story is really as good as their press releases make it sound. And today we're diving into a filing that's all about private equity and a whole lot of fees. It's AMG Pantheon Fund LLC's latest report. And let me tell you, it's a masterclass in juggling expenses, investments, and investor expectations. So what's the big picture here? AMG Pantheon Fund is basically a fund that invests most of its money into another fund, the AMG Pantheon Master Fund, LLC. Think of it like a Russian nesting doll for your money, but with more layers of fees. Their main goal is to grow your capital over the long term by investing in private companies, like those in private equity, infrastructure, also real assets and other private stuff, but also in other investment funds. Now, you can buy into this fund in different classes like Class 1, Class 2, Class 3, Class 4, and Class 5. Each of these classes has different minimum investment amounts and fees, which can really impact how much you actually make. Today, we're focusing on Class 1 units. They've registered a whopping $2.61 billion in units to be sold, which tells you they're looking to raise a serious amount of cash to invest. All Class 1 units are being offered at the net asset value, which means no sales load up front. Good for investors, but when we look at the expenses, it becomes clear where the money really goes. Let's cut to the chase, the expenses. For Class 1 units, you're looking at a total annual expense of 3.03% of the net assets. That might not sound like much, but when you're investing a lot of money, it adds up fast. They've got a management fee of 0.75%, plus other expenses and fees from the underlying investment funds they invest in, which is a staggering 0.90%. So when you add it all up, that 3.03% is what you're paying just to have your money managed. They also have an early repurchase fee of 2.00% if you decide to pull your money out before a year, which is pretty standard but still a sting. Now, there's a bit of a silver lining in that the advisor has agreed to cap total annual operating expenses, excluding certain excluded expenses, at 145%. If the fund's expenses go over this cap, the advisor will cover the difference. But here's the kicker. Those excluded expenses include things like fees and expenses from the private equity funds they invest in, transaction costs, interest payments, and even subsidiary taxes. So that 1.45% cap is really only for a portion of the total costs. It feels like a magician's trick, making you focus on one number while the real costs are hidden elsewhere. Keep in mind that 0.90% acquired fund fees and expenses aren't performance-based. They're recurring operating expenses from the investments themselves, which means they're paid regardless of how well those investments perform. So what are the big risks here? Well, they are upfront about it. Loss of capital for starters. They also plainly state that there's no plan for the units to be listed on any stock exchange, and they don't expect a secondary market to develop. This means your investment is pretty much locked in with very limited liquidity. They reiterate that units are subject to substantial restrictions on transferability and resale. Unlike buying stock in a public company, you can't just sell these units easily if you need cash or want to cut your losses. To provide some liquidity, they might offer to repurchase units quarterly, but even then they only plan to repurchase up to 5% of their net assets each quarter. And if too many people want to sell their units back, they might even prorate that amount or suspend the offers altogether. So don't expect to get your money out quickly or easily if you need it. The core of their investment strategy involves private equity, which is inherently risky. These investments are in private companies, often with limited operating history, which means they can be super volatile and you could lose your entire investment. They also highlight that these private equity investments carry a high degree of business and financial risk, which can lead to substantial losses. Remember that expense cap we talked about earlier? Well, that agreement with the advisor limits total annual operating expenses to 145%. But here's the catch. A huge chunk of those excluded expenses, like fees paid to underlying investment funds, those are not included in that cap. So while they say they're capping expenses, the real cost to you could be much higher if those underlying funds have massive fees, and if the advisor waives or reimburses expenses, they can actually recoup that money later from investors as long as it's within 36 months. This means the cap isn't really a hard limit on what you might end up paying. Looking at the Class 1 specific expenses, they pay a distribution and or service fee of every 75% of the net assets. This is for services like investor inquiries and processing requests. Think of it as a way to keep investors happy and informed, but again, it's another layer of cost. Now let's check out the financial highlights specifically for Class 1 units. For the fiscal year ending March 2025, the ratio of net expenses to average net assets was 0 than the previous year's 0.87%, which is good, but it's still a significant chunk of your returns going towards expenses. Compare that to the gross expenses, which was 1.56%. That difference of about 0.70% is essentially the amount the advisor and the fund are absorbing. Likely due to that expense limitation agreement, it's important to see that even with the CAT, the underlying gross expenses are still high. On the performance side for Class 1 units, the total return was 9% for the fiscal year ending March 2025. This is a decent return, but it's crucial to remember that this is before considering all those fees we just discussed. A higher return before fees would naturally mean higher dollar amounts paid in fees. Their investment strategy involves investing in private equity infrastructure and other private asset funds. These are long-term investments, typically 10 to 13 years for the funds themselves, and the companies they invest in often have 3 to 7 year holding periods. This means your money is locked up for a very long time and you won't see much action or liquidity until the very end. They're basically aiming for long-term capital appreciation. They also mention investing in subsidiaries like a corporate subsidiary and a lead fund. The corporate subsidiary pays US federal income tax on its income, which reduces the master fund's return. And importantly, any losses incurred by the corporate subsidiary can't be used to offset the master fund's income. This structure seems designed to navigate complex tax rules, but can also lead to inefficiencies, meaning less money for investors. Regarding risk management, they talk about allocating commitments across geographies and vintage years, managing cash, setting up credit lines, and using derivatives. While these are standard risk management practices, the core risk we've identified is the inherent illiquidity and opacity of private equity investments themselves. That 2.00% early repurchase fee is quite significant if you need to exit your investment within the first year. It acts as a strong disincentive to pull your money out early, locking you in further. They highlight benefits like access to private equity managers without high minimums typically required by those managers. They also hint that their secondary investments might lessen the J-curve effect, which is where funds typically lose value in the early years due to fees before realizing gains. However, the structure and fees still present considerable hurdles. On the tax front, they aim to be a regulated investment company, or RIC, which means they generally don't pay taxes on income they distribute to shareholders as dividends. But qualifying as a RICE involves meeting strict income and diversification tests. They admit that the lack of transparency in private fund investments makes it hard to monitor income sources and asset diversification, potentially limiting their investment universe and ability to comply with rice. The tax hit could be substantial. A really interesting and potentially concerning risk they mention is contingent liabilities associated with secondary investments. This means if they buy into an existing fund and that fund later recalls distributions previously made to the seller, the master fund, and by extension you might have to pay that money back. While they mention claiming against the seller, there's no guarantee they'll succeed. It's a bit like buying a used car and then finding out the previous owner still owes the bank money on it. They also have a whole section on cybersecurity risks, which is pretty standard now but still worth noting. They admit there are inherent limitations in their plans to prevent cyber attacks, and they rely on third-party service providers whose own security measures might not be enough. So, what's the final verdict on the AMG Pantheon fund? LLC filing. On one hand, they are trying to provide access to private equity for a broader audience and do have advisors actively managing the process. They are upfront about the high risks involved, including the potential for total loss of capital and the extreme illiquidity. On the other hand, the fee structure with layers of expenses and potential reinvestments creates a very opaque investment vehicle. The actual cost to the investor could be significantly higher than the headline expense ratio suggests, especially when you factor in those excluded expenses, and potential reinvestments creates a very opaque investment vehicle. The actual cost to the investor could be significantly higher than the headline expense ratios suggest, especially when you factor in those excluded expenses, and the performance fees charged by the underlying funds, the risks associated with private equity, magnified by the fund structure, and the lack of transparency in underlying investments make this a very speculative investment, suitable only for those who can truly afford to lose their entire stake and who are comfortable with a long lock-up period. Alright, that's our deep dive into the AMG Pantheon Fund, LLC filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord linked in the description below to keep the conversation going. Thanks for watching. See you next time. Hey everyone, welcome back to Corporate Decoder, the place where we take complex financial documents and break them down so everyone can understand them. On today's episode, we're diving into the latest filing from AMG Pantheon Fund LLC, and trust me, this one is packed with details about private equity, master feeder fund structures, and a whole lot of fees. It's like a financial puzzle, and we're here to put the pieces together smoothly. So first things first, AMG Pantheon Fund is essentially a vehicle that channels your money into another fund, the AMG Pantheon Master Fund. Think of it like a pipeline for your investments, leading to a larger pool of capital that then goes into private equity infrastructure and other private assets. Their goal is simple: long-term capital appreciation. AMG Pantheon Fund offers its units in 5 different classes: Class 1, Class 2, Class 3, Class 4, and Class 5. Each class has its own set of minimum investment requirements, fees, and expenses, which are important to understand before you decide to invest. Today we'll be zooming in on the Class 1 units. Now they've registered a significant amount to be sold, over $2.6 billion in units. This tells us they are looking to raise substantial capital. For Class 1 units, the offering price is linked directly to the current net asset value. This means no sales load up front, which is a nice break for new investors. But let's talk about what really matters to your wallet, the expenses. For Class 1 units, the total annual expenses are a hefty 303% of the net assets. That includes a 0.70 hefty 3.70% management fee, a 0.75% distribution and or service fee. Other expenses estimated at 0.68%. Importantly, acquired fund fees and expenses making up ever 0.90%. These acquired fund fees are essentially the costs of the underlying investment funds the master fund invests in, and they're charged regardless of performance. Now here's where it gets a little tricky. The advisor has an expense limitation and reimbursement agreement where they cap the fund's total annual operating expenses, excluding certain excluded expenses, at 145%. If expenses go over this cap, the advisor steps in to cover the difference. However, those excluded expenses include a lot of the direct costs from the private equity funds they invest in, transaction costs and subsidiary taxes, so that 1.45%. If expenses go over this cap, the advisor steps in to cover the difference. However, those excluded expenses include a lot of the direct costs from the private equity funds they invest in, transaction costs and subsidiary taxes. So that 1.45% cap is really only for a portion of the overall financial burden. It's like saying your rent is capped, but the utility bills are separate and potentially huge. The 0.75% distribution and or service fee is paid to help with ongoing investor services. It's a pretty standard but still significant cost that eats into potential returns. When we look at the risks, they are very clear. The first one is loss of capital, and they emphasize that you could lose your entire investment. This isn't unusual for alternative investments like private equity, but it's always crucial to remember. They also point out that the units are not traded on any stock exchange, and they don't expect a secondary market to develop. This means your investment is locked up, and getting your money out might only be possible through limited repurchase offers. These repurchase offers are also limited, usually to no more than 5% of the fund's net assets per quarter, and if too many investors want to cash out, they might even reduce that amount or suspend offers. So if you need liquidity, this investment might not be the best fit. Their strategy relies heavily on private equity investments, which are known for their long-term nature and illiquidity. These investments are typically in private companies, often without a long operating history, making them inherently more volatile and risky than publicly traded securities. They specifically mention that these investments involve a high degree of business and financial risk that can lead to substantial losses. Looking at the financial highlights for Class 1 units, the ratio of net expenses to average net assets for the fiscal year ending March 2025 was 0.86%. While this is a slight improvement from the previous year, it's still a considerable ongoing cost. The gross expenses, however, were a much higher 1.56%. That 0.70% difference is the amount being absorbed by the advisor, likely due to that expense limitation agreement we discussed. It's good they're covering some costs, but it also highlights how high those underlying expenses really are. For Class 1 units, the total return for the fiscal year ending March 2025 was 99%. That sounds pretty good. But remember, this is before those fees and expenses eat into your returns. With a 303% annual expense ratio, a significant chunk of that 9.09% is going to cover costs. If you had a 5% annual return, they estimate you pay about $51 on a $1,000 investment in the first year. Over 10 years, that balloons to 3 fund of 5. If you had a 5% annual return, they estimate you'd pay about $51 on a $1,000 vibe as Nanaron Bode vibe. Well, a dollar for a cent annual expense ratio. Over 10 years, that balloons to $355 on a $1,000 investment in the first year. Over 10 years, that balloons to $35 E1Rs on a $1,000 investment in the first year. Over 10 years, that balloons to 3 or 3% annual expense ratio. A significant chunk of that 9.99% is going to cover cost. They also mention investing in subsidiaries, like a corporate subsidiary. This subsidiary pays US federal income taxes, which reduces the master fund's overall return. And importantly, any losses from this subsidiary can't be used to offset the master fund's income, which is a tax inefficiency that can directly impact investor returns. Now, for a potentially concerning risk, contingent liabilities associated with secondary investments. This means that if they invest in an existing private equity fund and that fund later recalls distributions previously paid out, the master fund and thus your investment might have to pay that money back. While they have recourse against the seller, there's no guarantee they'll get that money back, adding another layer of risk to these already complex investments. So here's the bottom line. AMG Pantheon Fund offers access to private equity investments, which can be attractive for diversification and potentially higher returns. However, the structure is complex, with a master feeder arrangement and subsidiaries that introduce tax inefficiencies. The expenses are high, and while there's an expense cap, a significant portion of costs are excluded, meaning the real cost to you could be much higher than advertised. The illiquidity and the fact that your money is locked up for many years are also major points to consider. It's an investment for those who can tolerate significant risk, understand the long-term commitment, and are comfortable with a degree of opacity regarding the underlying investments and the ultimate cost structure. It's definitely not for the faint of heart or anyone needing quick access to their funds. Alright, that's our breakdown of the AMG Pantheon Fund LLC's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description below to keep the conversation going. Thanks for watching. See you next time.